Economic policy is how the federal government attempts to stabilize the economy, promote growth, protect economic rights, and manage the distribution of economic gains and losses. The government has two principal instruments: fiscal policy, the power to tax and spend, and monetary policy, the power to influence the money supply and interest rates, plus tax policy as the most politically charged subset. Let me take each in turn. Fiscal policy is the government's use of taxation and spending to influence aggregate economic activity. When the government spends more than it collects in taxes, it runs a deficit and must borrow to finance the difference. Accumulated deficits become the national debt. Expansionary fiscal policy, tax cuts or spending increases, puts more money into the economy and is typically used to counteract recession. Contractionary fiscal policy, tax increases or spending cuts, cools an overheating economy. The most dramatic recent example was the COVID-19 fiscal response, the largest peacetime fiscal expansion in American history. Between March 2020 and March 2021, Congress enacted approximately $5 trillion in emergency spending and tax relief, including the CARES Act, the Consolidated Appropriations Act of December 2020, and the American Rescue Plan. This extraordinary stimulus, combined with pandemic-driven supply chain disruptions, contributed to the inflation surge of 2021 to 2023, when the Consumer Price Index reached its highest level in 40 years. Monetary policy is controlled by the Federal Reserve System, the nation's central bank, which operates independently of both the executive and legislative branches. The Federal Reserve sets the federal funds rate, the interest rate at which banks lend to each other overnight, which cascades through the financial system to influence mortgage rates, auto loan rates, business borrowing costs, and ultimately the pace of economic activity and inflation. When the 2021 to 2023 inflation surge became persistent rather than transitory, the Federal Reserve under Chair Jerome Powell embarked on the most aggressive interest rate tightening cycle since the early 1980s, raising the federal funds rate from near zero in early 2022 to over 5% by mid-2023. The increases successfully brought inflation down from a peak of approximately 9% in June 2022 toward the Fed's 2% target, though higher borrowing costs significantly increased mortgage rates and slowed the housing market. The Fed began cutting rates in late 2024 as inflation continued to moderate.
Tax policy is deeply contested because it simultaneously determines the distribution of the tax burden across income groups and the aggregate level of revenue available to fund public programs. The progressive income tax, taxing higher incomes at higher marginal rates, has been the federal government's principal revenue source since the 16th Amendment in 1913. The Tax Cuts and Jobs Act of 2017 significantly reduced corporate tax rates from 35% to 21%, lowered individual income tax rates, and doubled the standard deduction while capping the SALT deduction. CBO estimated it added about $1.9 trillion to the national debt over a decade. Many individual provisions were scheduled to expire in 2025, making their extension a major legislative priority for the second Trump administration, pursued through reconciliation. Now let me also fold in the ACA, which was the most consequential domestic policy expansion of the last generation.
The Affordable Care Act of 2010 extended health coverage through Medicaid expansion, insurance exchanges with income-based subsidies, the requirement that insurers cover pre-existing conditions, and the individual mandate. It reduced the uninsured rate from about 15% before implementation to a historic low of around 7.7% by 2023. The law survived multiple Supreme Court challenges, most notably NFIB v. Sebelius in 2012. The 2017 repeal effort failed in the Senate. 3 Republican senators, most famously John McCain, voted against it. The ACA remains law in 2026.